Hello and welcome back to another episode of Word Wednesday. I'm your host, Paige Goodger, and I'm joined by my co-host, Bix Weir. How's it going, Bix?
It's going great. I'm happy we're talking about this topic today. It is very timely with what's going on in the world.
Yes, I agree. So I did a poll on our Instagram page and I asked people if they fully understand what shorting means, and 57% of people said no. So I thought this would be a great topic, especially with everything that's been going on in the news recently. So today we will be talking about short selling or shorting, what it is, why it's risky, and how the squeeze happens. So maybe you've heard by now that an army of retail investors has managed to use one of the hedge fund's most common investment strategies against them. That is short selling. Short selling involves selling borrowed shares of a stock with the belief that the price will drop, at which point you buy shares at a lower price to repay what you borrowed. Short selling is an investment or trading strategy that speculates on the decline in a stock or other security's price. So let's look at a micro example of how traditional shorting works and how people can profit off of this strategy. Let's say Bix has some rare Roto-Roota silver coins worth $10 each, and I think those coins are going to go down in value. So I call Vix and I say, hey man, can I borrow 5 of those rare Roto-Roota silver coins? And he says, sure, because he knows me and he trusts me. So I take those 5 coins and I sell them for $10 each, the current market price. A month passes and I was right about the market, and the value of the coins has dropped to $5 each. At this point, I would buy those coins back at $5 and give the 5 coins back to Bix. So I sold for 50, I bought for 25. That means I made a $25 profit. So this is how people can make a profit off of short selling. So Bix, how does a person or company open a short position and where are they borrowing from?
Well, they're supposed to be borrowing these shares before they sell them short, but in this world of high frequency trading and complete lack of regulation, you're allowed to sell short without even owning the shares in the first place, holding the shares, and it's insane. And that's how kind of they got into the little pickle they're in right now, these hedge funds. And it's a wonderful thing to see, but they're doing everything to stop the retail investor from profiting on this. Uh,
Mhm.
they're beating them at their own game, and they don't like that. The stock market is so full of fraud, and there's so much rehypothication of the actual shares that most of the brokerage companies deal in like pools of shares. Nobody really knows what anybody owns for real these days. So they don't even borrow the shares. And then there's the leveraged derivatives that you can use also to short. So you can really go after and destroy companies if you have enough backing and you have the regulators on your side, which the big hedge funds have for the past 50 years.
Yeah. Can you elaborate on the leveraging derivatives a little bit more and explain how short selling works by using those derivatives or with the rehypothecation?
Sure. Well, the leverage part means you're borrowing money or you're borrowing something. So you can place a bet with leverage, meaning say you have $1,000 and you want to bet against something. You can start with 1,000 and borrow another 10,000 because you're so sure of what you're going to, that the price is going to go down. You can throw it all at the share price, and then you'd make 10 times the amount of money you had. They charge interest for that. There's credit checks and all that. But you can do it. That's the leverage part. You're taking what you have, you're leveraging up. You're making double, triple, quadruple the size of your bet, which is great when the bet goes in your favor. When it goes the opposite way, you'll lose 10 times. That's why they had all these recently. They had all these margin calls, and margin call is basically the brokerage coming to you and say, "Oh my God, you're losing so much money. You need to give us more money just to stay in the game, or we're going to liquidate your holdings." If they liquidate the holdings, that drives the stock higher and higher and higher, because on a short sale, you can when you go long a stock, you can lose up to what you bet. If you bet $1,000 that a stock will go up and it goes to zero, you've lost $1,000. If you short, you can lose infinity money. If you short a stock $1,000 and then it doubles, all of a sudden you owe 2,000 and it triples, 3,000, quadruples, 4,000. You're in deep doo-doo, and there's no there's no stopping it. That's the position they got these guys in. Unfortunately, the regulators, the politicians, the hedge funds, the exchanges all colluded against the GameStop investors, so that now you're seeing these huge drops in the price because they're all trying to stop the inevitable destruction of the short position. We'll see who wins in the end, but when you play in their game, you gotta go by their rules, unfortunately.
Yeah. So can you explain how does short selling as a hedge protect gains or mitigate losses for these big hedge funds?
Well, as a hedge, I mean, a hedge is just you make one bet, and then in case that goes bad, you make another bet in the other direction. You're kind of hedging your position. Sometimes they use futures and options because they're cheaper to deal with. You can, for example, if you have silver that goes up, 1,000 times, and you're like, oh wow, this is up really high. I want to lock in some gains. You can take a short position out on the COMEX at somewhere less than that, or all of it. If I mean, they'll basically balance out. So there is a function of hedging in our current markets. The problem is that when hedges go bad, they can destroy everything, and the third party goes bad, and then the brokerage houses are on the hook, and they go down, and it's just collapsing. MF Global was one of those brokerage type companies that went belly up, and basically the person left holding the bag is usually the retail investors. If it's a big bank, they get bailed out. The little guy, no, you get screwed. So welcome to our system. Get out of the system. If you're listening to this, get out of the system.
So earlier this month, short squeezes occurred on several different stocks, including GameStop Corp and AMC Entertainment Holdings Incorporated, following efforts by retail traders on Reddit to drive up the price of stocks. This resulted in large price spikes as short sellers were forced to cover their short positions for substantial losses. These volatile price movements were not driven by fundamental factors or news about the companies. So what happened here? A short squeeze. In a nutshell, all the buying pushed up the prices, meaning the hedge funds' bets were wrong and they lost billions of dollars. Year to date, for the GameStop short sellers alone, the loss is at least $5 billion, according to S3 Research. A short squeeze happens when a stock begins to rise and the short sellers cover their trades by buying their short positions back. This buying can turn into a feedback loop. Demand for the shares attracts more buyers, which pushes the stock higher, causing even more short sellers to buy back or cover their positions. Bix, can you explain how a short squeeze is impacting the silver market right now?
Well, yes. Although I wouldn't quite call it a short squeeze. I would call it a realization of what's actually happening. There's a handful of banks, less than 12, probably about 4, that control the price of silver and have always controlled the price of silver, at least for the past 50 years since we invented computer trading programs. That the short position, whether or not it is naked short, which means there's no physical to back it at all, or an actual short, where I believe they are at least claiming ownership of SLV silver to justify the short position on the COMEX. You could say that was a legitimate short, and they are not being squeezed right now. But the more people who learn about this stuff and the games they play, the more people who will buy silver, and that will become closer and closer to an actual short squeeze. When the short squeeze happens in silver, which I think it will happen in the next couple of weeks, you won't see $1 rises in the price. You'll see the price go from, say, $30 to $80 to $100 to $1,000, because nobody will have the silver. More than likely, at some point, the exchanges will just shut down. SLV will no longer be available for purchase anywhere. And that's, remember, you're playing in their game. When you buy SLV instead of the real thing, silver, physical silver in your own possession, you're buying a derivative. You're buying a silver derivative based on metal that the banks actually own. The banks are the ones who are the authorized participants in SLV. So it's a little different. It's a much bigger scale. It's much more important. in that you are betting against the biggest banks in the world instead of some small hedge fund who made a mistake on a short position. And I think the little guy is going to take out the biggest banks in the world with some help. There's good guys behind the scenes. The Q movement, I think, is in there as well. It's time to get rid of this criminal and corrupt system, and there's no better way than to just run the silver price to the moon.
Yeah. Can you define SLV for people who might not know what that is?
Sure. SLV it's called an ETF, an exchange traded fund. So the idea is that you get a bunch of physical silver, you put it in a pile and give it to JP Morgan, who's the custodian, and then they issue shares, so that it's treated like a stock. You can buy shares of SLV, and each share of SLV is supposed to, every time you buy a share, they're supposed to put 1 ounce of silver in the big pool of silver that JP Morgan holds. That's why you see these huge amounts of silver being deposited into SLV. It means more and more people are buying shares of SLV. Thus, JP Morgan has to continue to fill the coffers of the big silver. I mean, the pile is huge now. It's about 600 and almost 700 million ounces of physical silver is sitting in that pile now. That's crazy.
A lot of silver.
It is.
So, do you think short selling provides liquidity, meaning enough sellers and buyers within the market?
Yeah, it does. It does provide liquidity, but it's a fallacy to think that liquidity is always a good thing. For example, on the COMEX, just yesterday, 2.1 billion ounces of liquidity was sold. I mean, that doesn't have any justifiable meaning in any world. So in that instance, liquidity can also be big players manipulating markets. And that's what I think. If you look at all stocks and bonds and the amount of shares traded compared to how many there were actually issued, it's completely out of control now. With computers and high speed trading, the game is falling apart. It's real scary because these exchanges and the markets are going to fail due to that extra liquidity. So it's great when it's under control, but when it gets out of hand, it's gone. It destroys everything.
So, can you explain the difference between shorting and naked shorting?
Sure. Shorting, traditionally, a brokerage house is supposed to have the share. They're supposed to be in possession of the share before they allow someone else to short. So if you are a shareholder, your brokerage house holds the share for you, and you usually give them permission to lend it out. It's hard to see in the contracts because the contracts are so small when you sign up for a brokerage account, but they're lending out your shares to other people who want to short it. And they're doing that at interest. So they make a little money by doing that. And that would be a traditional short. You have the underlying asset, and then you're just selling it because at the end of the day, you can match those two up, and voila, you've got a closing out of the short. The problem is a naked short is you've got one asset here, and you have 4 or 5 people wanting to naked short the exact same asset underlying it, and there is no cover. So if it ever happened that you had to match the assets, you'd have 5 shorts to 1 share of stock. That's what was going on in GameStop. That's what's going on in silver as well. Although they're trying to hide that from the world, but it's becoming more and more clear that the increased activity on the COMEX and the increased activity of deposits into the SLV are exactly matched. So the retail investors that think they're buying silver on SLV are not. They are giving the banks a way to lie and cheat and steal about their naked short on the COMEX.
Yeah. So, what would your advice be to people who might be trying to get into SLV right now?
My advice is run for the hills, get yourself some physical silver in your own possession with no third party. You don't have to worry about SLV shutting down. You don't have to worry about your brokerage house shutting down. You don't have to worry about them changing the rules on you. You don't have to worry about Robinhood stopping you from buying more shares than 2 or 3 that I think they allow. I don't know how many they allow, but they have stopped allowing large volumes of shares at Robinhood of SLV, of an ETF, which is supposed to be 1-for-1 silver delivery for every share you buy. So the fraud is changing. They're trying to get out of their problem. get out of their problem before you're forced out. Get yourself physical silver in your own possession, and then you can just sit back on the sidelines and watch all this craziness happen.
Yeah. So, can you explain what a double short means?
Well, like my first example was 4 shares. That would be a quadruple, triple. Yeah, that's a quadruple. A double short means there's twice as many. You're twice as short as the underlying asset. So in the case of GameStop, it wasn't really clear. Some people were saying it's 150% short of the overall float. But remember, a lot of people owned GameStop in their brokerage account that they weren't lending it out. So nobody knows how many shares were available to be shorted. So the number got so high, it was probably triple or quadruple short based on the underlying asset. So
Wow.
yeah.
Yeah. So, like you said earlier, that they like to change rules occasionally. So, can you elaborate on what type of rules they change and how that affects investors?
Yeah, sure. With the Robinhood, it's just been shown they basically stopped any retail buying from normal people and only allowed sales. Well, obviously the price is going to drop when you do that. They did the same thing to the Hunt brothers back in 1980 on the comics. They said, okay, no more buying of silver, only selling of silver contracts. Of course, the price is going to get slammed down. Other ways they do it, like on the comics, is they'll increase margins. So those banks or the people who own physical silver longs that aren't really well capitalized, they get squeezed out. Where the banks that can print money at willy nilly, they're always in the game. They can change rules as far as physical delivery. The comics can say, okay, all the contracts have to be settled in cash instead of physical delivery, because I think at the end of this month, that March is a delivery month of silver, meaning people can stand for delivery of 1,000-ounce bars. I think it's going to be by far the biggest month in human history if the COMEX stays in business until then. So we're going to find out pretty soon.
Do you think they will?
I think they're going to shut down before it actually happens.
When do you think that will be happening?
Well, there's only 16 days left until until this contract expires, and they got to start delivering. So 16 market days. So the end of February, I would be surprised to see the COMEX up and running properly. They might say, okay, no more physical silver, just electronic silver and settlements in cash, which would instantly make it null and void. The entire concept of that market will be completely illegitimate. It is already, but people give it a little legitimacy because they have a physical delivery component. Then you've got all these manufacturers like, wait a minute, Apple Computer, where are they going to get all their silver for all their computers? And Samsung's flat screen TVs, where are they going to get their silver? So yeah, it's getting really ugly out there in old Silverville, and it's been a long time coming.
Yeah, definitely has been a long time coming. So, would you have any advice for any of the Robinhood people who invested in GameStop?
Absolutely, congratulations! You have seen how the game works. You beat them at their game. You now understand that they control all the rules, and they can break the rules at any time. The next step is to take back your monetary sovereignty, get physical silver in your own possession, and then take your ball away from their game. That's how you do it. I learned this lesson 20 years ago in banking. The only way to get out of the system is to take your assets out of their game. You can do it with cryptocurrencies. Don't leave them in the exchanges. But the best way to do it is get the silver. Silver is the key to destroying the banking system. So all you Robinhood investors who got screwed by the change of the rules, definitely get physical silver in your own possession, because they can't change that rule.
Yeah, I think this whole Robinhood uh, scandal, if you want to call it, or, I think this
Debacle.
is really, what was that?
Debacle.
Debacle. There we go. The Robinhood debacle was it just opened everybody's eyes to see the pure corruption that's going on and the clear manipulation, the clear changing of rules. And You can't do that. That's what you teach the little kids. If you're playing a board game and they're like, oh, but I want this card or I want to do this, you teach them, no, you're not allowed to change the rules. And that should go for everybody. And especially banks or, people who are controlling money and the livelihood of investors. And there needs to be some type of integrity. There needs to be more integrity within the system. And right now, there's absolutely none. And we need to get back to having some morals within these financial markets and financial systems.
Well, that's the funny thing is, um, the morals were never there. It was just a facade of morals. It's like in the Wizard of Oz when Toto pulled the curtain away from the great and powerful Oz, and everybody saw the little man behind the curtain. It wasn't Oz up there with the smoke and fire. It was this little guy behind the curtain playing with computers. That's where we are today. We have just pulled the curtain away for probably 100 million investors to see what was going on behind the curtain. And now it's up
Yeah.
to us to get out of the system and get physical assets in your own possession only. Let that system fail, and then we can start up a new system.
Yeah, Reggie Middleton was on Jean Claude earlier today, and I loved what he said. He said the markets are healing right now. This isn't this isn't a bad thing. Everything is healing right now, and I really do believe we are moving into establishing morals in the system that has never had any. So I'm really excited to see where this goes, and I think that's where we're going to wrap up on shorting. Is there anything else that you would like to add, Vix?
I'm just very excited that all this stuff is becoming visible to the rest of the world.
Me too. Me too. Well, thank you so much for tuning in to this week's episode of Word Wednesday. I can't wait to see you next week and take care until then.